Hello everyone, welcome back to the channel. Today, we're delving into a seismic shift, the collapse of the Baltic-Black Sea port lines under Moscow's control, and the ripple effects of a roughly $50 billion trade lifeline vanishing, with many foreign companies apparently pulling out. What we're seeing is a complex mix of sanctions, logistics choke points, corporate risk reassessment, and geoeconomic realignments. The core of the story is that the network of ports that once linked Russia's Baltic Sea region to the Black Sea, enabling freight flows, energy exports, raw materials, and goods across a broad swath of Eurasia, is now under intense strain. One by one, major routes have closed, operations scaled back, and foreign firms that once relied on access have begun exiting, citing heightened risk, regulatory uncertainty, and logistical nightmares. To understand the gravity of this, consider that these port lines weren't just local or regional, they were strategic arteries. They connected Russian production zones, export terminals, and global markets. When such arteries begin to falter, the impact shows up in currency devaluations, supply chain disruptions, corporate earnings warnings, and a cascade of secondary effects in allied industries: shipping, insurance, finance, downstream manufacturing. In the coming minutes, I'll walk you through the timeline, the players, the mechanisms of collapse, the corporate exodus, and the implications going forward. Let's begin by revisiting how this system worked. The Baltic region, including ports like Primorsk, Baltiisk, and other major nodes, served as gateways for Russian exports to northern and western markets. Meanwhile, the Black Sea ports, for example Novorossiysk, handled flows towards southern Europe, the Mediterranean, the Middle East. One of the bigger operators here is Novorossiysk Commercial Seaport and CSP, which in earlier years managed both Black Sea and Baltic operations. In essence, Russia had developed a multi-port system that could route freight flexibly, depending on market demand, seasonal constraints, and geopolitical contours. Over the past few years, however, several pressure points emerged. First, Western sanctions tied to the 2022 Russian invasion of Ukraine began to bite, targeting finance, shipping, insurance, energy. They raised costs and risk premiums for firms operating in or through Russian ports. Second, maritime insurance and tonnage availability became strained as certain carriers either withdrew or flagged their vessels differently to avoid sanctions. Third, logistics chains were disrupted by closures, reroutings, and the loss of certain connecting services: rail to port, feeder lines, handling services. Fourth, corporate governance risks and reputational risks increased. Foreign firms reconsidered: is this region still tenable from a strategic, regulatory, and operational standpoint? As a result, one of the major outcomes has been the flight of foreign firms, or at least the announcement of firmer plans to reduce exposure. Some firms pulled investments, some paused ordering, some exited entirely. The value of the trade lines, conservatively estimated at around $50 billion, has shrunk or is at serious risk. The figure appears behind headlines reporting the $50 main links shut down scenario. What does this look like in practice? Consider freight volumes at key ports dropping, or shipments being diverted to more costly or longer duration routes, e.g. via northern ports, Arctic ice routes, or alternative supply chains through Central Asia or via Turkey. Companies that once leveraged Russian ports for low-cost exports now face higher insurance, longer transit times, and increased uncertainty over customs/regulatory bottlenecks. They begin to ask, is the premium worth the access? Many answer, no. Another key piece is the knock-on effect on Russia's revenues and strategic flexibility. Ports generate not just direct handling fees, but anchor broader industrial clusters: storage, refining, shipping services, logistics centers, customs processing, and export-oriented manufacturing. If the port network fades, so do the adjacent economic ecosystems. The ability of Russia to reroute shipments easily, maintain competitive export premiums, and sustain foreign investment in port logistics infrastructure diminishes. We should also reflect on timeline. While the collapse is not entirely overnight, the acceleration is noteworthy. Firms had been scaling back for months or years, but a tipping point has been reached where some major lines are reported gone or effectively closed. The headline Baltic-Black Sea port lines are gone sums up the perception of a structural change. That perception itself can accelerate exit decisions. When one major firm announces withdrawal, others follow. From the corporate side, what drives the decision to leave? Several factors. One, compliance risk. Heightened sanctions mean exiting late, can incur penalties, complicate audits, damage reputation. Two, logistics risk. If a route is intermittently available, companies can't rely on it for just-in-time delivery or contract fulfillment. Three, strategic uncertainty. Is Russia going to remain accessible, or will global trade networks isolate it further? Four, opportunity cost. Firms may find alternative regions more stable or cost-effective going forward. Five, capital risk. Port infrastructure often requires long-term investments. When horizon shortens, the ROI vanishes. Now, what does this mean for Russia and for the global system? On the Russian side, they lose flexibility and face higher costs. They may attempt to redirect more flows through the Arctic, through China route or via the Caspian, Central Asia corridors, but these are typically more expensive or slower. Also, the loss of foreign firms means less technology transfer, less investment in best practices, less competition in port operations, that in turn can degrade efficiency. Globally, it means supply chains will increasingly bifurcate. Firms that depended on Russian raw materials or exports via these ports will have to adjust, find other sources, change logistics partners, pay more. Shipping routes may shift. Insurance markets are adjusting premiums for higher risk regions. The broader consequence, trade segmentation increases, costs go up, choices narrow. We should consider specific sectors. For example, energy exports historically used ports as choke points. If certain ports are restricted, the cost of exporting oil, LNG, or refined products rises. Same for grain exports. Russia has often used Black Sea ports for large grain shipments. If those are disrupted, the global grain market feels the shock. Also, heavy industry and raw material exporters using Baltic ports to reach northern Europe may lose competitiveness. Another dimension, geopolitics. These port closures and firm exits signal to Russia that its access to global markets is becoming constrained. It may trigger policy responses: state subsidized logistics, alternative partners China, Middle East, or escalation of nationalization or state control of ports. It might also prompt Russia to retaliate or redirect flows through corridors that are less monitored. The so-called shadow fleet phenomenon, unregistered, obscure flagged shipping to evade sanctions, underscores how Russia may seek workarounds. For the foreign companies, the exit is not always clean or instantaneous. Many may scale down rather than pull out fully. Some may transfer ownership. Some may sell to local operators. The process can take months or years. Some firms will try to ride out the disruption, hoping things will stabilize. But the sense of a structural break, that this isn't just a temporary glitch, but perhaps a longer-term shift, is what accelerates firm exits. Looking ahead, several scenarios emerge. 1. A partial recovery. Russia may stabilize its port lines by investing in domestic logistics, substituting foreign firms with domestic ones, routing more via friendly states, and the $50 trade value might partially return, albeit with higher cost and lower efficiency. If the global sanctions regime softens or Russia adapts, firms may cautiously re-enter. 2. A structural decline. The port network continues to degrade, fewer foreign participants, rising cost premiums, deteriorating infrastructure, higher risk premiums leading to a long-term shrinkage of trade volume, and Russia's export competitiveness erodes. 3. A pivot to alternative systems. Russia may increasingly rely on Chinese-backed corridors, e.g., via Central Asia, the Arctic Northern Sea route, or build out its own internal logistics to bypass choke points. Foreign firms may follow those alternative routes, but that may still exclude many Western companies. 4. Geopolitical escalation. Further sanctions or military conflicts may result in additional closures, expropriations, or state takeover of ports. Firms may leave preemptively to avoid exposure. For you watching this, why does it matter? If you're in supply chain, logistics, commodity trade, insurance, maritime shipping, this story signals that one of the foundational networks of Eurasian trade is under real strain. If you're in investing or business strategy, be alert to firms with heavy exposure to Russian logistics or export infrastructure. Their risk profile has shifted. If you're in policy or geopolitics, this shows how sanctions and corporate withdrawals feed into structural trade realignments, not just temporary blips. Let me wrap up by summarizing the key takeaways. The network of Baltic-Black Sea port links under Moscow's umbrella has reached a critical juncture. Once valued at around $50 billion in trade flows, it is now facing shutdown, diversion, corporate flight, and uncertainty. Foreign firms are pulling back because of compliance risk, logistics unreliability, reputational exposure, and alternative opportunities. For Russia, the cost is rising, flexibility is dropping, export competitiveness is under pressure, and the strategic logistics advantage is eroding. Globally, supply chains are realigning, shipping/insurance markets are adjusting, and trade segmentation is accelerating. In short, this isn't just a port closure story. It's a story of global trade rewiring, where infrastructure, firms, geopolitics, and economics intersect. Thanks for watching. If you found this useful, be sure to like and subscribe. More deep dives coming. I'll see you next time.